Caesar Maasry, who's the head of EM Cross Asset Research, managing director at Goldman Sachs, now joins in to answer just those questions. And Caesar, thanks for joining in on board. As Nikunj was just alluding to, right now the Fed has delivered. Do you think the stock markets will deliver as well? Because for now there's a relief rally. Is it looking sustainable?
Yes, thank you so much for having me on. So we had, a very sizable 75 basis point hike today, or I guess yesterday perhaps. And that's significant relative to history. We haven't seen a hike like that since the 1990s, which of course was a very painful time for emerging markets. But before we get there, as you mentioned, have they done enough? Well, yes, it was in line with market pricing. Keep in mind, we're coming from a period of very high volatility, both in terms of market performance, but also the macro. We're talking about large inflation surprises to the upside, some growth slowing to the downside, and oil prices that keep on going up. So yes, I think they did what the market needed, so to speak, in the very short term, and we have a little bit of a relief rally. But there are some things that are, let's say, a little bit out of their control. I think oil is an important risk here, and that will also drive market sentiment and market performance. I'm not so sure rate hikes alone are a remedy to that. So our view is that risk is actually still going to be under some pressure over the summer months as we deal with a fairly rough macro environment of weakish growth and still relatively high sticky inflation. I think that spells a pretty rough patch over the summer.
Is it a given that it's a recession that we're staring at?
Our core view is still a soft landing is possible. I mean, we have a 35% or so recession probability that we've been talking about, so it's a significant probability. But I would just say, a couple things here. One is, I'm not so sure recession is necessarily the most important question. What I mean by that is we're coming from a period of very strong growth, at least in the US, 4% or so in quarters, not so long ago. So even if we slow to 1% or slightly below, then it certainly feels like a painful recession, right? And so coming with asset valuations from elevated levels, you're going to feel quite a bit of volatility. The second thing, just very quickly, is, again, what is a recession? If you look at the basic components, meaning goods versus services, the slowdown in goods demand is very likely happening. That matters for a lot of parts of the global economy, EM included, North Asia, the Mexicos, and so on. Services, which could, relate to travel and oil and things, probably don't decline nearly as much. And so I think it's very much a component issue. And this matters a lot for how you want to structure an investment portfolio.
Caesar, we've seen money moving out of emerging markets. We've seen money moving out of emerging market currencies. Given that Fed is on the path of tightening, do you think the outflows are here to stay and emerging markets will continue to see volatility?
Yeah, I think that's a crucial question, of course. In general, I think flows follow fundamentals, and I do think EM is in a little bit of a tricky patch here. Again, I think China is probably a little bit different from the rest of EM. We can discuss that. But as it relates to the Fed hiking path, as you've mentioned, again, I alluded to the 1990s earlier. Well, of course, a very crucial difference is EM central banks have been hiking well ahead of the Fed. Last year, we had on average 150 basis points of hikes across EM. This year, we've had already 200 basis points in addition to that. The problem is, if you look at rate differentials, they have compressed. So like the belly of the curve, 5-year rates, for example, we're at 4.5%. We had a 4.5% cushion of emerging markets relative to US rates to start this year. That was a nice cushion. EM currencies were actually fairly defensive in the first quarter. That rate differential has compressed to about 3.5% currently, which is quite low relative to history. So the point is, if we get further hawkish surprises by the Fed or hotter inflation prints, I think, yes, you will see outflows from EM and some underperformance tactically over the next 3 months, let's say.
The very basic question, a very basic elementary question, I may say so, that Fed has printed a lot of money during the pandemic period, and they've really expanded the balance sheet, which is that if interest rates, they go higher, the problem for Fed to service that debt could be nightmarish. How will they deal with this if rates go higher?
Yeah, this is all part of the equation in terms of quantitative tightening and financial condition tightening. again, hard to read into this because we're in a way in unprecedented territory, so you don't really have a historical playbook. I would just say I think forward guidance and the understanding of the balance sheet risks have been in the markets for quite some time, and I personally look or pay a lot of attention to the functioning of credit markets, which have been fairly okay for now. In the emerging market world, we've seen, of course, some defaults and restructurings in the frontier markets and the high yield paper market, but that has not been a sort of contagion risk into the rest of EM. So yes, I think what you're bringing up is an important consideration in terms of financial condition tightening, but I don't think it leads to a sort of a disastrous or an illiquidity problem across global markets.
Good morning. So, what we also heard Jay Powell say yesterday was that in the July meeting, we could see yet another rate hike of 50 basis points to 75 basis points. In fact, most of the press conference was actually about that forward guidance and the credibility of that forward guidance. But Caesar, if that does happen, there are experts also who believe that the US dollar index may not appreciate more, beyond the 105. Which camp do you fall in, and what will be the impact of that on flows and EMs?
Yeah, so you actually bring up a number of issues there. The first would be, let's just start with the dollar and EM. Absolutely, historically, there is a very clear inverse relationship where when the dollar strengthens, EM assets tend to sell off and vice versa. I would sort of push back on the idea that EM is driven by the dollar. What I would argue is weak EM growth drives the dollar stronger. And again, the vice versa of that. If EM growth picks up, again, perhaps China being one candidate there, that might help some dollar weakness. So I think this is a little bit circular and goes both ways. But to your direct question in terms of what we think about the dollar, it is expensive. It is expensive on most sort of currency valuation metrics that we would come up with. Again, the problem is, you can talk about financial condition tightening and the rate path forward, but we think of the dollar smile, to use that cliche. If the US economy is doing very well relative to peers, the dollar appreciates. But also, if we're worried about recession risk, the dollar tends to appreciate too. It's sort of that middle ground where you get dollar weakness. I think in the short term, we're still in that left part of the distribution, and I would not want to short the dollar here against EM currencies, for example. I think we're focused more on relative value opportunities, but I highly suspect over the course of the next 3 months, as we figure out one way or another where the cycle is going, you'll get a better entry point. And because the starting level of the dollar is very expensive, it'll be a good time to get back into emerging markets.
Okay, so that's the word that's coming in from Caesar this morning after the highest rate hike that we've seen since 1994. Thank you so much for being live with us and explaining us all of that and the impact on EMs.